In 2013, the Nobel Prize in Economic Sciences was awarded to 3 economists for their research into the behavior of stock market and asset prices. But in an interesting twist, 2 of the economists' body of work seemed to be completely at odds with each other. Eugene Fama said markets were efficient. Robert Shiller said they weren't. And Lars Peter Hansen built the statistical tools to test them both. So who was right? And where does that leave us now when stock market valuations, by almost any measure, are at exceptionally high levels? Let's start with Fama. Back in the 1960s, he proposed the efficient market hypothesis. At the time, it was a radical idea that asset prices reflect all available information. Stock prices only move when new, unexpected information hits the market. And because nobody can predict surprises, price movements should be random. Fama backed this up with data. He showed that stock returns followed a random walk, with no predictable pattern. When he plotted these returns, they formed a normal distribution, a bell-shaped curve where most outcomes cluster around the average and extreme events are rare. Now, it's probably worth explaining the normal distribution a bit more, because it helps us understand not just stock prices, but a wide range of natural and economic phenomena. Some of you may have already come across it yourself in secondary school statistics. The normal distribution was first observed by Abraham de Moivre, a French mathematician studying the probabilities of coin tosses. He discovered that when many small, independent random effects are added together, the outcome tends to form a bell-shaped curve. In other words, when enough randomness happens, the result looks predictable. We see this pattern not just in financial returns, but in human height, IQ scores, metabolic rates, lung capacity, almost anything influenced by lots of small independent factors. But let us consider a coin toss experiment just like de Moivre did. Here we have a pyramid of possible outcomes where heads sends you left and tails sends you right. That means the chance of ending up at the far left is very small. There's only one route. You have to get heads 4 times in a row. But there are a number of combinations that land you somewhere near the center. A few of them should be showing on your screen now. You can see clearly that there are more paths to the middle, which means that outcomes near the center happen more often. That is the normal distribution in a nutshell. To visualize this, we can use a Galton board, a device filled with rows of pins. Drop a ball from the top, and at each peg, it bounces left or right at random, just like flipping a coin. After enough rows, the balls land in one of many bins at the bottom. Drop hundreds of balls, and a clear shape emerges. Most land near the center, fewer at the edges, and only a few at the extremes. That's the bell curve. Even though each individual path is random, the overall pattern is structured. The Galton board shows us, in physical form, what the central limit theorem tells us mathematically. Many small random events produce a predictable bell-shaped distribution. Now, looking at daily returns from the S&P 500, I've taken 20 years of data from 2005 to 2025 and plotted the frequencies on a histogram. The result is quite striking. Daily stock returns form a bell curve, consistent with a random distribution. Fama found this same pattern in daily, weekly, and monthly returns, not just for indices, but for individual stocks, commodities, and interest rates. And this matters, because it suggests that all known information is already baked into the price, and that returns are driven by the random arrival of unpredictable news. The efficient market hypothesis doesn't claim prices are always right, only that they are the best guess based on available information. Prices adjust instantly to news. And since the future is unknowable, price movements follow a random walk, which means you can't consistently beat the market using public information. Then came Robert Shiller, and he wasn't convinced. In his landmark 1981 paper, Do Stock Prices Move Too Much to Be Justified by Subsequent Changes in Dividends? Shiller challenged the core logic of EMH. If stock prices reflect the rational discounted value of expected future dividends, then price movements should track changes in dividend expectations. But dividends are relatively stable. They don't jump around every day. So, if prices are rational, they should also be relatively stable. Shiller tested this by comparing actual stock prices to what he called ex-post rational prices. the present value of dividends that were actually paid out in the future. The result was quite striking. Stock prices were far more volatile than future dividends could justify. This wasn't a one-off. Shiller ran the numbers over long periods and consistently found that stock prices fluctuated far more than the underlying fundamentals. So what does that tell us? Well, it shows us that investors weren't calmly discounting cash flows. They were reacting to sentiment, storytelling, mood swings, in short, to psychology. And this paper laid the groundwork for what became behavioral finance, a field that argues markets are not just imperfect, but often emotionally driven. Shiller went further. Instead of focusing on short-term movements, he looked at the long run. He developed the cyclically adjusted price to earnings, or CAPE ratio, comparing stock prices to the average of real, inflation-adjusted earnings over the previous 10 years, a way to smooth out the business cycle. What he found had real-world implications. When the CAPE ratio was high, future 10-year returns were usually low. When the CAPE ratio was low, future returns were typically high. This shouldn't happen in an efficient market, but it was widely observed across markets and over decades. Markets weren't behaving like rational calculators. They were behaving like crowds, emotional, erratic, and prone to bubbles and busts. Shiller argued that investors are not always rational. They overreact, follow the herd, and get swept up in fear, greed, and the fear of missing out. These psychological forces push prices away from fundamentals, creating inefficiencies and mispricings. So who was right, Fama or Shiller? That's where Lars Peter Hansen came in. Hansen didn't choose a side. He built the tools to test both. He developed the generalized method of moments. It sounds technical, and it is, but the idea is simple. It allows economists to test how well theoretical models fit messy real-world data. Using GMM, researchers evaluated both EMH and Shiller's behavioral models. And the conclusion? In typical economist fashion, both were right. Fama was right that markets are hard to beat. Prices react quickly to new information, and most active investors underperform the market. Predicting short-term moves is nearly impossible, but Shiller was also right. In the long run, valuations matter. Markets aren't always rational. Psychology does play a role. Bubbles are real. So where does that leave us today? With markets near all-time high valuations. Well, if history is any guide, market valuations at this elevated level don't tend to end well. Shiller's CAPE ratio is hovering near 37. Ignoring the COVID blip, this is a level we last saw in the dot-com bubble. And every time valuations have been this high, future 10-year returns have been weak. Often just 0 to 3% per year in real terms. That doesn't mean a crash is coming tomorrow. Markets can stay expensive, or get even more expensive, for longer than anyone expects. But it does suggest we shouldn't count on a repeat of the last decade's gains. So while Fama tells us we can't time the market, Shiller reminds us not to ignore the price we're paying. And that is the takeaway from all of this. In the short term, prices may rise on hope, hype, and headlines. But in the long run, they still have to be grounded in the fundamentals. A link to the next video and Nobel Economics Prize playlist should be showing now. Just click to keep watching. I hope you enjoyed this video. If you did, then please like, subscribe, and comment. Thanks for watching.